Good afternoon, Larry, John, Sheila, and the rest of the Larry's Laminate team. We here at Star Capital are excited to have the opportunity to work with you, and we've put together a team of our top associates to advise on project cover. So first, I'll go over our agenda real quick. We will be introducing our team, telling you a little bit about Star Capital. Then we will get into our situation analysis and key findings, which will lead us into our fair valuation for Larry's Laminate, as well as recommendations moving forward. We've also included an appendix at the end for reference on our calculations. Max, would you like to kick off our introductions?
Yep. So hi everyone, my name is Max Ganshorn. I'm a managing director here at Star Capital with 20 years of investment banking experience. Really looking forward to work with your guys' team.
Thanks, Max. My name is Cooper Lyons. I'm also managing director here at Star Capital and head of mergers and acquisitions here. Really looking forward to working with you all.
My name is Jack Rafith. I'm head of leverage finance here at Star Capital.
My name is Yusuf Masood, managing director and head of equity capital markets, and I'm really happy for this opportunity.
And my name is Tyler Fond. I'm head of equity research here at Star Capital. So first, I'll give you a brief overview of who we are at Star Capital, along with some of our past accomplishments and prior services provided. We are headquartered in Chicago, Illinois. We have over 70 years of relevant transaction experience, which has resulted in us advising on over $60 billion to date. We deal primarily in transactions valued between 30 and 700 million in consumer and industrial focused industries. Our main goal at Star Capital is always to draw on our past experience to provide the greatest value for clients. Some of our past accomplishments would be recognized by Mergers and Acquisitions in 2022 as Investment Bank of the Year, being a Forbes Top 100 company, and placing first at the 2022 M&A Awards. So now I'll go through some past deals that we've worked on that would be relevant on project cover. Most recently, we've worked with Stepstone Capital on both the buy and sell side. This gave us great knowledge into who their management team is, as well as knowing how they operate on the buy and sell side. We think this would be extremely valuable on project cover. Outside of that, we've worked with companies such as Carlisle, Toyota, and Ranger to build our knowledge of the industry. So now I'll turn it over to Yusuf for our situation analysis.
Yeah, just a brief overview of our situation here. On the left here, we have a really impressive team of managers who has really been able to build Larry's Laminate into what the company is today. At the top, Larry, founder, you really have been able to expand the business. We understand you own 70% of ownership. You're looking for a quick exit, and you're really looking to maximize the value in your company that's works of art to build. Next, we have John Green, Chief Executive Officer, been able to really lead the company. We understand you represent 20% ownership. You're looking to roll some of your proceeds into the new co. And then Sheila Branch, CFO, been able to help the company weather through some tough, turbulent market conditions. We understand with 10% ownership, you're looking to also remain in business and roll some proceeds into the new co. On the right here, we have our two main situations, either engaging with Stepstone or a management buyout. Now, we understand you guys have been in talks with Stepstone, and like Tyler mentioned, we've worked with Stepstone in the past. We know their key management, we know how they think, and we really think that those relationships with Stepstone Capital managers, their execs, we really think we can help you get the best value for your business. In terms of multiples for the business, they flashed a 7 to 8 times EBITDA multiple for the acquisition, with 4.25 times debt to equity. Debt to EBITDA, I apologize, and their target IRR is ranging from 20 to 25%. They want Larry to stay on for 1 to 2 years, but we think we can negotiate that. And they would be interested in John and Sheila both rolling over some of their proceeds into the new co. Next, we have a management buyout. Now, John and Sheila, you guys have done a really impressive job raising the capital that you guys have. 5 million of your own, 20 million from friends and family, 20 million from lenders, and then a 5 million seller's note. This situation would include a 30% equity rollover. Next, getting into the industry. Larry's Laminate is a special, and you guys have a really strong asset in this industry, and it's a really durable industry, as we've seen through market conditions. Over here on the left, in the dark blue, you see actual revenue figures as you can see, Larry's laminate, CAGR of 4.5%, and we see those projections going in to 2027 as well. Industry growth is looking to grow at 1.1% in combination with input costs such as raw materials, petrochemicals, going down by 5% each year until 2027. We took that into account in our projections in our modeling with increased gross margins, increased net income. So that's really important to know as well. And all of this information really helps us understand the industry because we're really excited about this opportunity to work with you guys today. I want to pass it on now to Max for fair value recommendation.
Yeah, thanks, Yusuf. So after comprehensive analysis and rigorous model testing, we decided the fair value of equity for your company is $65 to $82 million. And looking at equity or enterprise value, that's around 7.5 to 9 times your EBITDA multiple. And thanks to financials and forecasts generously provided by management, we did do a detailed discounted cash flow analysis, and that provided really the base of our fair value for your company. And that provided a higher but also wider range, which we got through rigorous sensitivity analysis by sensitizing both the EBITDA multiple and then also our estimated WACC we came to. Secondly, we looked at precedent comparable mergers and acquisitions transactions in the past few years. And because some transactions, depending on which period you're looking at, were really in a hot M&A market, we decided on those more similar to now, which is in that slow market. And that still provided a higher valuation range, which we thought did accurately represent the fair value of your company. Thirdly, we looked at publicly traded companies and their comparable multiples, and that really did provide a lower value than what we truly believe is the fair value of your equity, and in part because the companies we were looking at did have revenues far exceeding your own, which really makes a comparison difficult. But secondly, we are in definitely a lower market than what we're used to, and looking at these comparables, that's definitely going to provide a lower valuation. So we didn't factor that in too much to our fair value of equity, just to be fair for our valuation. Lastly, we looked at StepStone's offer and modeled it into a LBO, and with their flash 7 to 8 times EBITDA multiple, it did provide a really accurate floor valuation for our fair value, and that's because it really finds an adequate price for appropriate returns they're looking for when they take on that much debt to purchase a company. And as you can see, management's offer, really putting it into the terms of equity value and how much they could buy out the equity, it's $40.3 million, which just isn't in our fair value. You guys would have to raise additional capital or take on more financing to really be able to reach that. And if Larry were to choose that, he wouldn't get as much, his pre-tax cash out wouldn't be as much. But with our fair value of equity of that range, Larry was 70%, looking at around $55 million pre-tax if you were to cash out 70% to 0%. John's portion is worth around $16 million, and Sheila's portion is worth about half that, $8 million. And next, I'll pass it off to Jack, who's really going to run you through what options you have on the table for this situation.
Perfect, thank you. So after completing our fair value analysis, it's important to understand all the different options of how to proceed. First, we highly recommend engaging with StepStone Capital Partners. This is because they're a motivated buyer, so this will help us negotiate the terms of the sale and also the price. And they also have a strong projected internal rate of return, which Cooper will speak on next. However, StepStone is anticipating that Larry would need to stay on for 1 to 2 years, and we think we can negotiate this with StepStone. The second option is a management buyout by John and Sheila, and this would allow for existing management to remain in control, and Larry can also partially cash out. However, with the current fundraising, management is not able to reach our fair value, so this would result in a much lower offer value. So therefore, we can also urge management to raise more funds for recapitalization, and this would just give John and Sheila more time to raise money and reach that a closer value towards our fair value analysis. And again, this would allow for existing management to remain in control. However, there's a couple challenges with this. Larry would have to wait for the payout, and the company would remain status quo in the meantime. And there's also a potential, depending on how they raise the funds, that there would be too much debt on the company. And finally, we could also just pursue a broader sales process. And because of the expected margin expansion and stable growth of Larry's laminate, we think this will attract many more buyers and increase competition, and hopefully raise the offers a little bit higher. However, Larry would also prefer a quicker transaction, so we don't know how long this would take. And there's no guarantee that a better deal would arise. And finally, there's the issue that StepStone may back out entirely. And so I will pass it off to Cooper now to talk about our final recommendation.
Awesome. Thanks, Jack. So based on both our evaluation models as well as our evaluation of shareholder preferences, we recommend that you do engage with StepStone with a counteroffer valuing the company at 9x EBITDA, bring the enterprise value to about $104 million and equity value to about $80 million. And our rationale for this decision was four-pronged. So firstly, we believe that an LBO from StepStone has the potential to really give all shareholders what they want out of this transaction, whether that's rolling over equity into the new co or casting out of their position. For Larry, this could look like going from 70% to 0% and realizing the full value of his company, whereas John and Sheila could either go 100% of their equity into the new company or 50% is an arbitrary number for them. So secondly, we also believe that, given Larry's goal of achieving maximum value on this transaction, StepStone's offer really gives the best multiple we can look for here, especially compared to the management buyout transaction. This is just due to StepStone's ability to easier access to funds, as well as having the lenders already know what their space is in the private equity world. Looking at lenders flashing about 4.25 EBITDA to leverage there. Thirdly, with growing margins, low capital intensity, and a niche position in the market, we believe that L&O is an extremely attractive asset for StepStone to look into acquiring. It fits well with both their current portfolio as well as their growth strategy here. So with that, we believe that we can counter them at that 9x multiple and really try to realize that full value of the acquisition there. And finally, to wrap things up, we do believe that, as the people touched on before, it is a weakening M&A environment. Deal flow has been drying up a little bit here. So we'd like Larry to get this deal out of the way sooner rather than later before we see a wider market downturn to really realize maximum value there. And below here, we have some shareholder exits that you could look at. Larry, we want you to go from 70% to 0% and really realize the full value of your company there. And while StepStone has said they want you to stay on for 1 to 2 years, we believe we can negotiate this down, not to stay on at all, and really kind of check all the boxes for you there. And John and Sheila, you can see right here, we have modeled going to 50% of your current equity portion, but we also believe that if you wanted to maintain fully into the company and roll over all of your equity, StepStone would also be okay with that. And that's just kind of the layout of that. And then just looking at the deal timeline and sales process here, we have both engaging with StepStone as well as pursuing a broader process, just to give you some perspective between the two timelines here. So as you can see, we're already in phase 1 right now of talks with StepStone. We're live with them, having live discussions. So our next step there would be to counter with that 9x multiple. From there, we're going to negotiate back and forth until we receive an LOI from them in which we enter our 60-day exclusivity period with them. And in that exclusivity period, we'll work on due diligence, finalizing contracts, and making sure that John and Sheila have the positions that they want in the new co, and kind of figuring out the structure with that. And once that's all finalized, you guys will have a closed deal, and hopefully everyone will leave feeling satisfied and getting what they want out of this transaction. And as you can see here, I won't dive into the broader sales process too much, but it's a much lengthier, much more time-intensive process. And I know, Larry, that's not something you want to do. But really just wanted to highlight here that StepStone is the best way forward, in our opinion, and we'd be happy to work with you guys in this transaction. So with that, we're open to any questions that you may have. Thank you for your time.
Let's assume you own this company.
Mm-hmm.
My son Larry doesn't own it. Let's assume you guys own it. You sell it now, given market conditions? And follow up to that, why deal with one private equity group when the world's your oyster?
That's a great question. So kind of what we touched on before was that we do see this, if there is a recession impending or current market conditions kind of continuing to decline, that the multiple continues to compress. And we know that Larry wants to get out of the company relatively soon. So we feel like it's either now or you have to wait 3 to 4 years down the line. And in terms of your question about, there's a bunch of private equity firms, why don't we open it to more? We did kind of look at what the broader sales process would look like, and we know that Larry doesn't really want to go through that.
No, I asked you, what would you do if you owned it? Forget Larry.
Mm-hmm.
I'm asking you as representing, if you owned it, what would you do?
Mm-hmm. Well, I think that the multiples would be similar throughout all private equity companies. I do think you might be able to get a little bit more competition and competing offers if you went to a broader process. But again, I don't own the company. We're just looking at your preferences here. So that's what I would recommend.
Thank you.
Do you envision getting to 9 times, which is a turn to 2 turns above what StepStone already bid, being just straight debt and cash, or do you think there'll be an earn-out component?
So we initially just thought it would be a straight cash offer, and with a 9 times, it is higher than what they offered because it was 7 to 8. But I think starting at 9, it's not too high. We'll look at it and be like in disbelief. It's more of a great place to start, and then if we work our way down, Even if we work our way down 20 million more, so it's still going to be in that fair value, and you're going to get a great cash out opportunity.
100%. And also just building off that, we want to take Larry's preferences into account here. He doesn't want to stay on. He wants to retire immediately, and an earnout would likely require him to stay on for those 1 to 2 years.
How do you get paid?
How do we get paid? We've modeled 3.5% of transaction fees, and that of enterprise value, and that encompasses not only our fees but also the projected fees for the refinancing of the debt.
And that's just for Stepstone,
Correct.
not the broader, or not a targeted process with a broader audience?
I believe it would be the same percentage of enterprise value depending on if it was either way. Either scenario would be the same, yes.
Sometimes these private equity firms come in and you can sign something up at 9 times. And then when they do their due diligence, they find something that they say, we can't support 9 times anymore. It's got to be something less. Is there a walkaway number where we should break up? If we were to sign with Stepstone and this sort of happens and the deal goes sideways, is there a walkaway point at which we should go broad?
Yeah, I think starting it at 9 times definitely gives us that advantage because we're starting high enough and still in that range where if it works its way down, we're still getting great value from the company. If it gets anywhere below 8, I would definitely pursue a broader process just because you can get a better offer. I think the risk versus return is a lot better if you do pursue a broader process at that point. But we do believe, working with Stepstone in the past and what they've been offering now, there's always room for negotiation. We think, a 9 times is realistic value.
Just looking at comparing, and you don't have the cash flows modeled out for the LBO analysis, but is it getting a little tight, or do you really think that that quantum is achievable in today's markets? I just look at the unlevered free cash flow and kind of the $10-ish million context over the projected period. Granted, I'm looking at the DCF analysis and not the LBO, but I don't see a model here. Do you think you'll be able to cover interest expense?
If it was 4.25 times?
Yeah.
Yeah, well that is how it's modeled in the LBO, and
it's 27.
yeah, and according to our projections with the LBO model, we should be able to pay that off, have enough excess free cash flow to pay down that debt as much as we need to.
There it is.
Yeah.
Yeah, I'm just curious, in the broader sale process graphic, you've got, a month in here to assess market sentiment. Can you talk to me about kind of what that means and looks like? And if you don't know market sentiment, how do we know 9's a good ask of Stepstone?
No, that's a great question. And I mean, we have already started that, looking at some of those comparable companies out there. But we really just want to take a deeper dive into some more transactions within that space that aren't public transactions, just looking at what some of the private equity firms have done more in the middle market side of things.
Can you talk more about your experience of working with Stepstone in the past? You've just done 2 deals with them in the last 2 years. How would you compare them to dealing with other private equity firms?
I can take this one. I think really it comes down to kind of the relationships we've been able to build with Stepstone. We know them on a personal level, so we think, that rapport we've been able to build of mutual respect is really going to come in handy when we are trying to pursue this process with your business. Compared to other private equity firms, I think we haven't worked as much with one single firm in the past, so we think that this built-up relationship is really going to come in handy here in this transaction.
Will you let them know this is, that they're it? Meaning, it's not an auction? What if they ask you, who else you going to?
We're of course not going to give up that. No, we're here to. No, we will not, because we're here to treat the shareholders, and then if we were to do that, I think they would lock in a lower rate because they know you're less likely to pursue that broader process. We've worked with them in the past, but that doesn't mean we're giving them information that's going to help them. We're going to be hired by you, not them, and we're here to really get you the best value that we can get.
And at the end of the day, they wouldn't know that until we enter our exclusivity period with the LOI sign. And while it is a weakening deal environment, there is still a lot of dry powder to be deployed by these private equity firms, especially in the middle market. So we think that they won't take it for granted they're the only one in the process.
Well, when would your team be able to start?
We can start as soon as possible, as soon as you want. Yeah.
I have a question. John and Sheila are really important in this business going forward, no matter who's the owner. So it's important to sort of show them why this is the best step, and I think you did that on page 13, but I'm not much of a math guy. Could you walk me through kind of the upside for them that you're showing on the bottom of slide 13?
Definitely, yeah. So that, going from decreasing their holdings by 50% was just to show the potential that they are able to get cash out of their position in the company.
Even simpler, like treat me like I'm a fourth grader and walk me through, because I see like 80 million in equity value at the top of the page.
Yes.
And then how do you calculate these amounts at the bottom on 13?
It would just be, so if you're going from 20 million to 20% to 10%, you'd multiply 10% by that 80 million in equity value.
Yeah, because the equity value is split between the three owners of management,
Yes.
Larry, John, and Sheila. And from that equity value, Larry's portion is worth 70%. And so if you were to cash out, he'd get that full 70%.
So I've got 80 million at the top, right, for equity value?
You're giving me a little bit more than you thought.
Times 70%, which would be like 56.
Yeah.
I think this is 67 on my version. Am I missing a number in the middle there? Maybe go back, click. Let's see what I'm talking
Yeah,
about.
this clicker isn't working, but if we can help one of the. Thank you very much.
So there's a discrepancy between.
Yeah, just the $68 million in cash for Larry. I think for that, so we did do the 9 times multiple. Maybe that was more of an optimistic run out for in that case, but I think what we were really trying to show there is that, at this multiple, Larry is receiving a significant amount of money in a great fair value range. And John and Sheila, while they do have the opportunity to roll over as much equity as they want, it honestly would be in the best interest for them to roll over all their equity. And then also, we really believe Stepstone would want that too, because then, John and Sheila have skin in the game. They'll have opportunities to really work themselves in this management position. And with their taking on additional debt, they could own a majority of the board because they would be at 50% once they do take on that debt.
Is it, back to the original, is it the 80 times 70%? Gets me to 56. How much is Larry getting, I guess is the question. Is it 56 or?
Yeah, so it'd be,
He'd be getting 70% of the equity value of the transaction.
so it would be 56. I guess we've mistyped on there, but yes. He's looking at around a $56 million cash payout, and that is pre-tax. If you were to go 70% to zero, John would be, because he owns 20%, he'd be looking at more around $16 million. But that's just for his portion, because we honestly believe it's in his best interest to roll it all over, but he can cash out if he'd like to.
Got it. So then he'd get 8 and 8, essentially, right?
Yes.
If he
Yes.
rolled 8, he'd get 8 cash and then half that for Sheila.
Yeah.
Okay, so
And it's in whatever interest management would like to take. If they'd like to cash some of it out, they more than well have that opportunity, but Stepstone might prefer, and they might prefer to roll it all over. Any other questions?
Thanks for coming in today.
No, thank you very much. We appreciate the opportunity.
good job.
Great job, thanks.